Out what he's been doing in this market. Deepak, hi, good afternoon. Great to have you on the show. Just spellbound by the move on SBI, Deepak, wondering whether you need to now widen the pool for PSBs, still pretty cheap, but do you restrict yourselves to SBI or do you add more to the bucket?
Good afternoon, Aisha. I think the PSB pool has been quite interesting. There are some underperformers for sure in terms of earnings and growth and quality, but some of the top level banks and even the mid level banks here, after the consolidations kind of run through their balance sheets, taken about 2 years now. 2 or more years, and I think there are lots of attractive opportunities here. I won't take names, but then I think a lot of these public sector bank players, given that the new normal is likely to be lower NIMs for the industry as a whole, I would say that public sector banks are positioned to be slightly better, and they're trading at perhaps one time book or sometimes less than one times book as well. Of course, now that has changed the equation. The value seems to be changing quite a bit, but I would say that 1 to 1.5 times book is where the opportunity is, especially if you're going to grow for 12 to 20% per year on earnings. That would make for a very reasonable buy there. Though I wouldn't write off even the mid-level private sector banks, some of the larger private sector banks also, where I think scope for return after the return of credit growth, we're at around 15% on credit growth, is going to be quite good going forward, so the history will not look so good.
I wonder, Deepak, with regard to just the way in which some of the PSU banks are, the story is unraveling or playing out, and in terms of the strength of the results, do you believe that there warrants a re-rating with regard to the way in which they are currently valued? So you suggested that a 1 to 1.5 time book may well be something that will start to become normal where PSU banks are concerned. Outside of SBI, pretty much all of them are trading at in around the one time book level. Do you believe that the re-rating towards 1.5 could well be very real now, and how quickly can that happen?
I think it depends eventually on growth and the quality of earnings. If you don't destroy your quality in terms of adding too many provision layers or having a portfolio concentrated in one sort of area which could lead to stress, I think overall they could be re-rated on the upside going forward. Remember also that in the budget, there was a specific thing about CPSCs, and I hope PSU banks will be included in that, would be able to monetize some of the properties that they own by putting them into REITs of some sort. Now, that is actually a big opportunity for some public sector banks, because they've bought these, some of their real estate maybe 30 or 40 years ago, and or even more than that. They own them at book price. The revaluation doesn't help them in tier one capital at all, or only a portion of it helps in tier one capital. So it's better for them to actually formally divest themselves of it, put it into an REIT, and then use that as tier one capital to fund growth. So they don't even need to recapitalize to a certain extent to get growth. So I think these are the factors that might actually help them. So A, growth without losing too much in terms of asset quality, and B, remonetization of your real estate portfolios, that could cause a re-rating in some way. And I think the overhang in a lot of these public sector banks of the government selling stake has gone down considerably in most places now, below 75% when I checked recently.
Interesting. Okay, Deepak, hold on to that thought. Lots more to talk about, but we're going to take a very quick break. Come right back. We'll continue our market discussion with Kunal Bothra and Deepak Shenoy. Back with closing trades right here on ET Now. Other than SBI, the stunner since budget actually has been the entire capital goods as well as the EMS play. Deepak, both cap goods as well as EMS has had its fair share of correction all through last year. Anything that's looking good for a buy right now?
Interesting. We can't talk about specific names,
Sure.
Aisha, but I do have a. I mean, my feeling here is generally in EMS semiconductors in specific, I think has a good longer term future here. Some of the inputs may become cheaper in some way if we have a deal with the US that actually reduces tariffs on some of the goods and on the machines that we might be able to import to build more of this internally. I also think that much of their capex that's happening right now will only reflect in revenues in 2027. So it's a little bit of a longer term thought process here. In the short term, order flows will probably determine a lot of the short term revenues, short term cash flows. But you should look at this sector only from a 5 year plus kind of perspective. Right now, it's not a useful thing to look at them as a short term. Oh, our revenues are so much, or we're giving guidance of so much and all that. It's actually not very relevant this year. I would look more at a 5 year long term presence where I think they should be a multi-fold of their current revenues and their current profits, with slight bettering of margins because of management of input costs and some scale based leverage. So I think that way, I think I'm positive on the sector as a whole. But EMS per se, I mean, not necessarily all of the players will make money here.
Okay. So what's looking like a good structural story right now, Deepak?
This is one of them, of course. Semiconductors in one place, and the other one is, of course, I think high tech manufacturing in India. The impact of some of the changes that are happening in the budget, perhaps the deals also, is going to lead to a lot more domestic manufacturing. And I would say, in general, therefore, the capex oriented plays in the beginning, and eventually the manufacturing plays themselves, whether they're in high precision manufacturing tools, auto ancillaries. All of these areas should do tremendously well in the next 4 or 5 years. So you should find a lot of players now at relatively low PE to growth ratios. Look at their potential growth stories and look at that as another sector. Um, the area around electrical transmission, whether it's DC, whether it is parts of that ecosystem, you're manufacturing products for this ecosystem, you're doing services for this ecosystem. I think that is also an area which will benefit tremendously from an increased focus on energy production and eventually, therefore, energy transmission and management. There's not that much in the nuclear area I could say is listed, but that would be another important area to look at. And finally, I think the rare earth strategy that the budget has revealed, I would like to see more concrete announcements about that. But I think that is another area where we can see a lot more gains again in the 5 to 6 year period because of the tax holiday that they've been offered, and therefore potentially investments in the space can be high yielding going forward.
Right. Deepak, thank you so much for joining us this afternoon. We'll let you go on that note. Very good speaking with you as always.